Bitcoin keeps going up in price, despite never becoming useful money, despite failing every test of real value, despite a real country proving it doesn't work. Today I'm going to show you exactly why that's not a mystery, and why it might be the most important financial warning you hear this year. My name is probably familiar if you've been burned by crypto predictions before. 6 months ago, I made a video calling MicroStrategy a leveraged time bomb. Since then, the stock is down more than 50%, and nearly $100 billion in market cap has evaporated. Before that, I made a video about how fragile the broader crypto industry really was. Since that video, the global crypto market has lost over $1 trillion in value and is down more than 30%. I'm not telling you this to gloat. I'm telling you this because both of those videos were built on the exact same idea. That underneath all the narratives, there is a much simpler and much more uncomfortable truth driving Bitcoin's price, and that truth has a name. It's called the greater fool theory. It means the price of an asset doesn't need to be justified by anything real. It just needs someone willing to pay more for it later. Before I prove that to you, we need to start with a question almost nobody actually asks: what is Bitcoin supposed to do? Because if we don't know what it's supposed to do, we can't know whether it's doing it. In 2008, a person or group using the name Satoshi Nakamoto published the original Bitcoin white paper. The title was not digital gold or store of value. It was a peer-to-peer electronic cash system. That's not vague language. That's a precise engineering brief. Bitcoin was designed to let people send money directly to each other, without banks, without intermediaries, without fees, without friction. And if it had actually done that, it would have been one of the most important inventions in human history. But it didn't, and the gap between what Bitcoin was supposed to be and what it actually became is where the entire story lives. Economists define money using 3 tests, and these aren't opinions. They're the standard criteria used in university economics departments around the world. Test 1. It must function as a medium of exchange, meaning people widely accept it as payment. Test 2. It must function as a store of value, meaning you can hold it and spend it later without the purchasing power collapsing. Test 3. It must function as a unit of account, meaning prices are actually set in it, not just converted into it at the moment of sale. Bitcoin fails all 3. Not narrowly, it fails each one in a way that would disqualify any other asset from being called money without a second thought. Let's start with medium of exchange, the most basic test. The Bitcoin network processes roughly 500,000 transactions per day. That sounds like a lot until you learn that Visa processes 65,000 transactions every single second. Bitcoin's entire daily volume could be cleared by the Visa network in under 8 seconds, and the energy cost of this inefficiency is staggering. A single Bitcoin transaction carries a carbon footprint equivalent to approximately 1.5 million Visa transactions and consumes as much electricity as the average American household uses over 43 days. This is not a payment system. This is the most expensive, slowest, least scalable way to move money that has ever been invented at scale. Now, what about the store of value argument, the one you hear most often from Bitcoin believers? The logic sounds reasonable on its surface. Bitcoin has a fixed supply of 21 million coins, and historically, things with limited supply hold value. But there's a critical difference between limited supply and stable value. A store of value needs to reliably preserve purchasing power, and Bitcoin is historically one of the most volatile assets in the world. An asset that can drop 20% in a single month is not a store of value, it's a speculation. Businesses can't price in it, households can't plan with it, and no serious institutional treasurer would park the company's reserves in something that swings that hard, that fast. The second problem with the store of value argument is one almost nobody talks about: ownership concentration. Roughly 2% of Bitcoin addresses control 95% of the entire supply. When ownership is that concentrated, price movements can be triggered by a relatively small group of large holders. We already have a live example. Jane Street is currently being sued for allegedly helping engineer the 2022 crypto winter and wiping out $40 billion in market value. And the fact that this is even legally possible says everything about what kind of store of value Bitcoin actually is. The third test, unit of account, is the quickest to dispense with. Even companies that accept Bitcoin as payment don't price their products in Bitcoin. They price in dollars, then convert the amount at the moment of sale. Bitcoin isn't acting as a measuring stick, it's just passing through the transaction like a foreign currency at an airport kiosk. Now, I already know what the Bitcoin community is going to say to all of this. We haven't given it a fair shot yet. Bitcoin is still early. You can't judge it before it's had time to develop. Here's the thing, we actually did run the experiment. In 2021, El Salvador became the first country in the world to adopt Bitcoin as legal tender. This wasn't a small pilot, it was a full national rollout. The government built a digital wallet called Chivo, legally required businesses to accept Bitcoin as payment, and handed every single citizen $30 worth of free Bitcoin just to get them to try it. Think about what that means. Legal mandate, government infrastructure, a financial incentive, every structural barrier removed. If Bitcoin was ever going to prove itself as real, functional money, this was the moment. The results were published by the IMF, the National Bureau of Economic Research, and multiple independent researchers. Bitcoin accounted for less than 2% of El Salvador's remittances. After everything, the law, the wallet, the free money, 98% of people sending money internationally still chose the traditional financial system over Bitcoin. And it gets worse. When the Chivo wallet launched, millions of people signed up immediately, but 60% of them downloaded the app, collected the $30 bribe, and never made another transaction. Meet Rosa. She's a nurse in San Salvador, whose family in the United States sends her money every month. When the government launched Chivo, Rosa downloaded it. She claimed her $30, converted it to dollars within the hour, and went straight back to Western Union. Because the fees were clearer, the rate was reliable, and she knew exactly what she'd receive. Rosa is not an anomaly. Rosa is the 98%. Today, 66% of El Salvador's population considers Bitcoin a failed project. 77% believe no further public funds should be spent supporting it. This wasn't a lack of adoption. This was rejection after a fully funded, government-mandated trial. The experiment ran, the results are in, Bitcoin lost. So if Bitcoin fails the medium of exchange test, fails the store of value test, and fails the unit of account test, and if a real country tried to prove otherwise and it still failed, where does the price come from? This is the question that cuts to the core of everything. Strip away the marketing, remove the narratives, ignore the memes and the influencers and the conference stage energy. What you're left with is one of the oldest concepts in finance. The greater fool theory says that the price of an asset doesn't need to be justified by any underlying value, as long as there's always someone willing to pay more for it later. Bitcoin doesn't generate cash flows like a stock. It doesn't produce anything like a commodity. It has no widespread utility. Its price is 100% dependent on the belief that someone else will buy it from you at a higher price. And this is why every narrative you've ever heard about Bitcoin exists. Digital gold, future of money, inflation hedge, hedge against government corruption. Each one serves the same function, to recruit new buyers, because new buyers are not just nice to have, they are the only mechanism keeping the price alive. The moment new money stops entering the system, there is nothing underneath. Watch how the cycle actually works. A narrative spreads. It attracts new buyers. New buyers push the price higher. Higher price attracts more buyers. More buyers push the price higher still. The cycle repeats until it doesn't. This is not investment. This is the largest real-time experiment in the greater fool theory the world has ever conducted. And the only question that matters is, how many fools are left? It might not be today. It might not even be tomorrow. But eventually, mathematically, inevitably, you run out of greater fools. And when that happens, there is no cash flow to fall back on. No commodity to consume, no utility to sustain demand. There is only the price, and the price needs a buyer. So before you buy Bitcoin, or buy more Bitcoin, or tell someone else to buy Bitcoin, ask yourself one honest question. Who are you selling it to? Drop that answer in the comments. I want to know what the Bitcoin community actually thinks is waiting on the other side of this trade.